going to work. So yeah, we're going to talk about impact exits. What does this mean? There are two very important words. One, exit. What does that mean? And what we talked about today is really about when you, as an investor, you're invested into a company, how do you actually exit this investment and get your money back? But there's also the impact involved, and that's where we want to focus on today. Like, how do we make sure that even beyond like an exit of an investment, the impact stays into the company? And there are different ways to do that. I mean, a traditional way, you would think an entrepreneur has an idea, starts a company, at some point needs some investments. Investor comes in, mostly invests equity, and then after a certain amount of years, say like 5 years or 10 years, they say, now I ideally would like to have my money back. And that's when the exit comes in. Somehow an exit needs to be created. And I guess traditionally there's often two ways. You sell it to another company, or potentially you make an IPO, you go to the stock exchange, and the risks there are that maybe a mission drift happens. Maybe the new buyer is not as impact aligned as you were. It has huge implications on the team, on the entrepreneurs themselves, and also the impact created. So we want to talk about the next hour a little bit more, what options are there to actually preserve the impact, and how to already think about a potential exit down the line at the time of the investment. So, yes, right question.
Katie.
This is like a closed fund, right? It's like if you're like actually making an investment and you're actually closing it to say that, listen, you're going to get your money back, you know, within 10 years, not even like in 5 years. Or could you do like a combination of both, of having the option to exit earlier, but not with a whole amount of money?
Absolutely, we'll get to all of that. I kind of just showed like one example of maybe how traditional it is, but there's many more options. And I think that we want to show today some examples, also what has worked, what have not. And so I'm Kristin Siegel, I'm leading the European network of Tonic. Tonic is a global network of impact investors, mostly private impact investors, high net wealth individuals, family offices, and foundations. And our investors have had a series of exits, and so have learned quite a bit about how can an investment be structured to really preserve the impact. But I'm really delighted to have this amazing panel with me, and we'll hear from all of them, like Sebastian on my left had an exit himself, now actually started a steward-owned company. We will learn what that means, to actually a totally different approach in terms of how do you bake impact into the company and preserve it long term. Then Taly, also serial entrepreneur, has had also a series of exits, will share her experiences and thoughts around impact. Then Rune started Rockstart, impact accelerator, and now VC from the Netherlands in 2011, I think. So also lots of exits to share. And finally, Erwin Stahl, fellow traveler from Munich, started BonVenture over 20 years ago. I think you have been for 30 years in VC investing, so lots to learn from. But maybe to get a feel of who is in the room, because I mentioned entrepreneurs, investors, but maybe also policy plays a role. Who would identify as an entrepreneur in the room? Okay, several, great. Who would identify as an investor? Also quite some, great. And who would identify maybe as like policy maker or part of the government? Also, great. Did I not touch on something like, I don't know, part of NGO or intermediaries? Impact Hub, great, yes. That counts definitely, very much. Okay, wonderful. So yeah, maybe let's dive in and let's hear from our panelists. Maybe Taly, may I start with you? You have had an exit out of from your solar company in 2012, I think you said, but now also working on a new company, Innovopro, and are working on scaling that. What are your thoughts around impact and also potential exits?
So I agree with your definition that impact is one thing and exit is another. And sometimes there are several years, like maybe 5 to 10 or more, between an entrepreneur that would like to make an impact. And I think this is the part where entrepreneurs think much differently from impact VC when they start the business. So they usually start the business with this impact vision. They would like to change the world with their new innovation, maybe a new product, a new process. And from what I realized, meeting with a lot of entrepreneurs and being one myself when I was a young one, they rarely think about, let's say, the steps to an exit. They want to do impact. They want to conquer the world with their new product, with their new innovation, with their new process. So I think that there is, first of all, a gap in thinking when this entrepreneur full with passion and ideas and really innovative technology is coming to speak with those impact investors that immediately are thinking about the exit. They do have those models that they have. They do have those, let's say, promises to their LPs how to make returns, and they need to study this impact entrepreneur, impact new startup with many tools, and they need data for that. And sometimes those startups really lack the data. So I think quite on the beginning of the journey, that is a mutual journey for VCs and for startups, there is an exploration for the exact data, and the impact data is something new. Because usually entrepreneurs were looking to build a business plan. And now when they are thinking about also meeting the KPIs of an impact VC, they need to have much more data. So I think they do come from the same idea, making impact, making the world better with their technology, influencing for the good. But the dialogue between the two can sometimes also, not only in the beginning, maybe on later stages when the startup is considering how to scale up. So there are many ways to do that. Is it a way that is with less emissions, more emissions? So there is always the dialogue between the investors and the startup about those KPIs.
It's a very important aspect. It's really what we call a re-diligence, right? Like each one, both investors and entrepreneurs need to work together and like be aligned in the mission of what they want to achieve. So I think maybe yes.
Just one thing about the exit. I don't think that an entrepreneur is quite, let's say, have a plan regarding how to do this exit, meaning their most ambitious is about growth, about getting to profitability, about hiring the right talent. So they have a lot on their plate. And I think that they get to think about the methodology to exit on a very later stage. And I think that the impact VCs do that much earlier, meaning they think about the route to the exit much earlier than the startup.
Thank you. By the way, I think we're a small enough group. If you have any questions, you already modeled it perfectly. Feel free to chime in and let's have a conversation.
I already did. I jumped straight into it.
Please go ahead again.
No, but maybe it's a good segue because Rune, you have worked with entrepreneurs directly, now also are wearing the VC hat. Like, what is your experience around exits and maybe also now the role as investor and how investors and entrepreneurs can better talk to each other?
Yeah, I think actually it's quite interesting how the VC model have changed since we started, like back in 2011. We used to tell founders that it was very important, they were very focused when it came to their market. But then you looked at most VCs and actually they had a quite general approach to investing. They were not really specializing. So they were not putting themselves into the market with saying, we are very, very good at this very particular thing. So come to us if you want to build a company in XYZ. I think that's one of the learnings that we have picked up along the years, that we want to be an expert in a few areas where we feel there's a significant need to be transitioning. So we identified the energy market to be the first one we wanted to address. And then later on agri-food as the second. And that's basically giving us like very purpose-driven founders because we've been extremely clear about our own purpose. So we are funding the transformation to a regenerative and sustainable future. That's what we're putting on our website. That's what we're putting out there. And that means that anyone who really want to have a true impact in the world, other than a financial return, is much more likely to come to Rockstart. Now, entrepreneurs at a very early stage, we invest in pre-seed, so we've done a lot of like small tickets, like 100,000 to 250,000. We've done more than 350 of them, and then we continue to follow and invest together with market partners up to Series P. So when we meet entrepreneurs, I think actually I personally do not like if you already start thinking about your exit at a pre-seed phase. That's a little bit of a red flag for the entrepreneurs in the room. I like if they talk about the value proposition, the value they're delivering to their customers. I think that's what you should be focusing on at a very early stage. And the interaction with the VC, in this case us, we should be the one challenging on the ambition. So we should be the one saying, hey, why don't we look at is there a way that we can make this even more exciting, even more impact? We have this great example of one of the first companies we invested in called hops.com, basically a distributed production platform for prototyping different kind of parts. They had like Tesla, they had NASA and different clients like that. And when they came in, they said, we're gonna create 3,000 hubs across the world. And our role was to say 3,000, well then you're only looking at it from a Dutch European perspective. Why don't we try to scale this up and make it a lot bigger? And they ended up setting a target of 30,000 hubs throughout the first initial, we had sort of a program that we ran for them, and in that period they basically changed the ambition of the company, which I think the role that we need to have. We need to push the entrepreneurs to think a lot bigger. And it's a European complex that we have, because in the US you have the opposite. You have everyone talking about billions and trillions early on, but we tend to sometimes not think it global from the beginning. So that's what we try to help them with. It ended up becoming a big exit of $330 million US dollar to an American company 11 years later, and they managed to hit the 30,000 hubs. So we're very proud that we sort of together was able to formulate that already in the initial part of the company. And I think if there's anything you can challenge yourself on is more the vision and the purpose of the company and how far you can take it at an early stage, over start thinking about exits. I think exits will come the moment that you have scale. Then there will be companies very interested to acquire you. So that's not even a worry.
Let's talk a little bit about the exit. How easy or difficult was it to find that other company that was overtaking or buying out that company?
Well, at scale, it wasn't too difficult, to be honest. It was a competition of, so if you come to a certain size, you can find an investment banker. They have a lot of experience in representing the sellers. So they talk to all shareholders. They're like, okay, where are we moving within? What price do we want to sell at? And we were sort of anywhere between X and whatever, 350 million, right? That's where we would like to land. And then you have professional market makers who goes out and find the top 5 companies who want to acquire you, and then the betting starts. That's if you get to a certain size. If you don't have the size to be able to get to a couple $100 million in valuation, it's much more difficult to get a good investment banker working for you. And then you're on your own, so you have to learn everything for the first time, right? You have to go out and find potential acquirers and negotiate everything. That's difficult. That's very unlikely that's actually going to succeed if you don't have the scale. So focus on getting to a scale where you become an interesting party for a stock listed company, for example, right? So if they have a market cap of 10 billion, they're not going to buy something that's worth 10, 20 million, right? They want to buy something that's worth 200 million. So that's the kind of mindset you need to have early on. If you don't get to that scale, you don't get to work with the market partners who can give you access.
Thank you. Now that's one approach or one thinking around scale. I think we have 2 other examples also when we're thinking about the impact exit. And Erwin, you have worked with BonVenture for 20 plus years. And in the beginning, we're actually more focusing on debt, right? So less equity. And then also over time moved into more equity investments, but there actually at the beginning already thinking more about the impact and what can you also write in a term sheet to preserve the impact. Maybe you can share a little bit more about your journey and how your thinking evolved and maybe some examples around exits.
Yeah, for sure, thanks. Maybe some words on BonVenture. BonVenture was set up by 4 wealthy families in 2002, and we set up our first fund in 2003 with a very small volume of 5 million euros, and trying to transfer what I did in the 90s for a traditional venture capital company, investing in deep tech solutions and products and companies, to the social and ecological sector. So at that time, we didn't have words like impact, SDGs and stuff like that, but we realized at that time that there is a dimension, not only the financial return, but also the impact space. With the first fund and that 5 million euros, we invested in 8 companies, mostly in non-profits with loans. And to wrap that up, we didn't lose any investment with a loan in a non-profit company, had always a financial return with interest, small interest rate usually, but we could pay back the money, or the non-profits could pay back the money. Brings us to the word of exit. In those cases, quite easy. You just pay the money back if you have a loan for 5 years, and after 5 years you pay the loan back. We set up the second fund in 2009. Same thing. We had as a goal, as a financial goal, just to pay the money back to the investors and reach a high as possible social impact. What we did, fund is still running, but the problem is, with only, or fund perspective, only paying back the money of the investors, you could usually not find enough investors to raise a higher volume for your fund. So we changed, after having 3 people from Bain in a strategy meeting for 3 months, I think, at our office. We changed with our BonVenture 3 fund to a setup where we had the goal to pay 3 to 5% net to the investors. Actually, with that fund, we are at anywhere between 6 and 7%. Not ended up to now, but our perspective is that we will overreach that goal of 3 to 5%. In that case, and from BonVenture 3 on, we did especially equity investments, not loans. Why? Not to be capped in your financial return. And that is one reason. And the other strategic shift was to raise a higher volume and to sign and invest bigger tickets, to have better economies of scale. So where we are now with BonVenture 4, this is a fund we are actually investing out of, has a volume of 50 million euros, and we usually invest 1 to 2 million in the first stage, usually with equity in impact-related companies. Impact is prerequisite. We make an impact analysis for each of our projects with the investment. We define goals for impact when we invest. And one thing that is absolutely important for us, and that differs maybe to your view, we talk to and discuss with the founders what can be the exit way in 5 to 8 years or 10 years, because we have to sell our stake, our investment. This is something we make very transparent and discuss it with the founders, and usually the longer it takes, and you are absolutely right if you say, if you have a successful company, it's quite easy to sell. You share your stake or the whole company if the founder wants. But as longer it takes, and usually after 6, 7, 8 years, you have specific points you arrange in your shareholder agreement that you can sell your shares. That means, for example, not necessarily doing an IPO, but that you are free of to sell your shares to a third party, always with the right for the founder to buy those shares before an external party. What we have made good good performance is also arranging a put-call option with founders who do not want to sell their whole company. So we have that done with, I think, 4 or 5 companies to arrange as one possibility to exit and sell our shares, to arrange a put-call option. So that means in 6-7 years, the founder, when the company is successful, can buy back our shares for the company and be the only shareholder of the company. On the other side, we have a call option, put option. That means if there is enough money in the company, we can sell back the shares to the founder or the company. And that is something that is maybe not doing very, or a lot of funds and investors, but we had made good experience out of that. So, excuse me?
Do they buy back? How's the experience?
Yes.
Yeah, most of them.
Usually we arrange at the time of investment a specific multiple on revenues and earnings, and with that multiple we buy the shares, and 5 to 8 years later we sell the shares. So you participate in the growth of the company. That means if revenue doubles, your investment doubles.
No, I mean, do they buy back their shares after, or do they give them?
No, you're right.
Yeah,
I think
yeah.
you were actually asking, like, putting the put call option in isn't actually then used.
And the founder can buy those shares or the company by itself.
What are the fields that your investees come from?
Excuse me?
What are the fields that your investees come from? He said energy, agriculture, right?
To be honest, it's the whole SDG program, but we have, as we focus on the DACH region and also doing investments in other countries than DACH region in Europe, but 80% of our investments are in the DACH region. We have some specific topics that are more important because we get a more deal flow on that. That is education, digital health, climate and nature. Yeah. These are the typical investments, I would say. But we have not one specific focus that we only do education or stuff like that, or climate.
I have a maybe naive question to this specific use case. I assume you work with founders who are dedicated to working full-time on ventures. So if they don't have the money in T0, how do they have the money to buy back the shares from T7?
If you have a for-profit business model, you usually earn money with your company, and then the company has some money to buy.
The company that buys the shares.
Yeah. But it's also possible that the founder names a third party, he agrees with and wants to go on in his way or her way, that is taking over that option. The same. I mean, the fact is that you have to go out after, let's say, because you have a specific lifetime of a fund, that is usually 10 to 12 years. And if you invest in year 2, after 10 years, latest, you have to sell your share. So you have to find possibilities to exit. And the more possibilities you have, and you have discussed with the founder from the beginning on, the better it is for you and the better exit situation you have.
And how do you deal if you come to the end of the fund and there's still no exit on some things? If you're coming to the end of the fund and there's still no exit, what do you do?
I mean, you have specific. I know a venture capital fund that is a traditional venture capital fund that is has a lifetime of 12 years and now is running 24 years. So this is one example. You just don't get a management fee on those 1 to 2 projects that are still in the fund, but you try to avoid that. Second possibility is you set up a special purpose vehicle. Third possibility is you pay out to your LPs the shares of the one company you have left. It's also a possibility. Or you, and this is the easiest way for a fund, not end the fund after 12 years, but after 14, 15 years, and don't get a management fee on it.
Yeah, maybe to add one concept, just there's also like a way to not make this closed-end fund, but what's called an evergreen fund. You have to to manage liquidity throughout it, that you don't have this pressure of having to sell after 10 or 12 years. So there are a few funds that are coming up now, like Aquaspark, Unsustainable Oceans in the Netherlands is like one example, and there are a few others more.
They're like hybrid, basically. They're hybrid. They allow you to exit earlier if you want to.
Right, to provide some liquidity. It's not obviously daily liquidity or anything, but yes, they allow you to exit a little bit earlier, bringing other investors in and have that on a rolling basis. Exactly. One quick last aspect just on the impact, as we talk about impact exits. But you also do an impact analysis for every company you actually were investing in, and even your carry as a VC is tagged to the impact. Maybe you can just say 2 sentences about that briefly?
Yeah, as you said, we have an impact-linked carry. That means we make an impact analysis and goals for impact for each of our projects we invest in. Now you can say we set the impact targets as low as possible so that we always reach them, but this would be too easy. The impact targets are set by our board of investors that consists of the biggest investors in the fund, biggest LPs in the fund, and they say that target you have for that company 1 or 2 is okay, or you have to set that higher or lower or whatever. So we decision what the target is done by our LPs and the investors board, and at the end of the fund, if we don't reach 100% of the impact targeted, the financial return and the carry on that we get is totally donated. If we reach our impact, we get as a management team a carry interest.
Thank you. So that impact link carry is also like something we see, I would say, more and more happening. Not as much yet, but really that you commit as a VC also to, like, for us it's really important to create the impact, right? And if we do an amazing exit, but the impact is not happening, then you don't get your carry either. So that's really important where also impact and, financial return come together. Thank you so much, Erwin, for sharing really like more on from the investor perspective and also really from the entrepreneur perspective. Mostly thinking around the enterprise will be sold at some point. Now I want to come to an example with Sebastian. I want to call you a serial entrepreneur, and also now when you set up your current company, Neue already when you set it up to think of in which way do I want to set it up. Like there are new structures that actually preserve the impact, and it's called steward ownership company. So would you share with us a little bit your journey and how does this setup work also in terms of bringing investment capital in?
Sure. So I co-founded Blinkist 12 years ago, and there we had very classical venture capital investors. When I started the company, I didn't even know what an investor is because I studied psychology and not business. And then learning through the process what it means to have investors basically being the owners of the company. Like for me, this wasn't really a good entrepreneurial setup. I know that not all venture capitalists are like this, but for me, my perspective is that the entrepreneur should always be in charge of making decisions in the company and not have investors on board who can fire him if he goes left instead of right. So when I started my next company 5 years ago, Neue, we started it in steward ownership, which means that the control always is in the company. So it's impossible that anyone outside the company has any voting rights and control. There are different ways of doing it. In my case, it's like there's a separate entity that owns at least 3 days a week, can be part of that entity with one vote then. So this is basically the board. And there's one veto share that is in a foundation to make sure that we don't change the rules because it would be possible. And we do work with investors, and when we started searching for them 5 years ago, there were very few of them, so it was quite hard to raise funds. I think right now we raised in total maybe like a little over 1 million over the years. I think now you will find rounds maybe up to 5 million euros, but like if you want to do something that requires a lot of capital, then probably steward ownership is still not the right tool. And maybe one thing to add, I started a mix of a philanthropic and investment fund, and we also invest in steward-owned companies, which means as investors we never have voting rights, and usually there are different ways of structuring it, but there's always like a structured exit, which means that you don't have voting rights, but there's very clear rules when the company, for instance, has to buy back the shares. So there's it can be a loan, but it can also be non-voting shares, plus an agreement that, for instance, when the company starts making profits, then you have to take 50% of the profits to buy back shares, and you calculate the value by, in our case, it's something like between 6 and 10% interest per year, and then it's capped at 2.5. So the maximum investors can get back is then 2.5 of their investment. So an exit is also possible, but it's more this structured exit, which I think is a good tool, but of course if your fund needs uncapped returns, then that doesn't work.
Just briefly checking, how many of you knew about steward ownership? Quite some. So for some of you, I guess Patagonia, right, is also one a good example of that. Maybe you can share a little bit more about also what Neue Narrative is doing, because I think there it's so important, right, really focusing on, that's my words, journalism, really preserving democracy, where you say you don't want to be influenced, I guess, by maybe the capitalistic system. Was that one reason?
Yeah, absolutely. Neue Narrative is a journalistic media organization, and I think especially in media, I don't think it's good if investors have control over a media organization. I mean, it can get as bad as Axel Springer, where the biggest investor in fossil fuels gets control over the media organization. But even if it's not as bad, I think it's never good if a media organization has external investors on the table when it comes to making decisions. So in this whole, we are also starting a second investment field, which is for journalistic media organizations. And there we see a lot of organizations that are either in steward ownership or cooperatives or non-profit. So there's typically not this classic structure where a venture capital would come in anyway. Yeah, which I think makes it doesn't work in that field in particular.
Yeah, so you have really clear impact you want to create long term, right? And you as an entrepreneur actually do not have an intention to exit the company at some point, but really continue it to scale, to grow it. I think Taly, that's also a little bit right, what you're really thinking about, scaling it.
I spoke in the beginning about the impact and the fact that an entrepreneur, the last thing that they think about, I think, when they are just fresh and starting their journey is about an exit. They want to build the business. They want to see it growing. They want to take more market share. They want to have the possibility to scale up. So many times an exit can come either as a surprise in early stage. I think this is what happened to us in Solaria. Sometimes the surprise is good, sometimes is less, meaning the regulation had changed in the solar system or in the solar ecosystem, so there were conditions that selling the company was the best thing to do. So for an entrepreneur, it's sometimes like losing its baby. And I think many entrepreneurs, when they face exit, they're not always that happy, although they should, but sometimes they want to keep on going and grow the company, and exit comes. So exit is a good surprise. Sometimes it comes earlier for an entrepreneur, and sometimes they need to be very much successful and hit those 100 million and more valuations in order to be attractive for those bankers and those big firms to be bought by. And there's always, the middle, that is the challenging part on how to grow, how to get funded along the way. And I think this is the main concern about the CEOs or the entrepreneurs, how to grow the business, how to get funded, how to find the right people to do that.
Rune, what was your example, like your experience working with the entrepreneurs? Like after the exit, did they actually stay in the company, or did they kind of went on to new things, or did you stay in touch to see, like, did the impact continue after the exit?
It's unfortunately very, very challenging, I think, to actually integrate often a smaller business with a different culture into a large organization, and I think it's hard for the ones who built the company to also change their mindset and their emotional connection to the company, which they often have all the way towards an exit. And sometimes it is a bit of a shame, because we have seen some of the businesses actually being pulled apart inside a large organization. But luckily, I think the spillover effect of these founders suddenly having capital and having enough resources not to changes also a little bit that perspective I see. So anyone that done like significant exits where it's very clear that they have like 5 to 10 times more than they actually need for the rest of their life, they start putting money to use in a very different way than they did before. Like actually investing in very different kind of businesses, more impact related. So I think that spillover effect you do get from an exit like that, even though from a founder perspective it might not be an easy breakup to have. And I think, obviously the steward ownership model hopefully can also create some more long-lasting businesses that actually could grow up to become a true challenger for some of the existing corporates who's absolutely not going to be able to shift to the more sort of modern mindset, right? They might want to do a slight part of it, but they don't really want to transition because it's just too painful for the existing business line. So that is a great example, because I think what it used to be was this idea that you could probably IPO a company, and I think with existing private investors, it's like really far-fetched actually to go all the way to IPO. There's just going to be a lot of pressure along the way to get out and for some of them and sell early on. So I think the spillover is a very positive thing that you get for entrepreneurs that make double-digit million output. That's what I've seen, at least.
Thank you. Yes?
Can I please say something that I have participating in this Vienna art? I come from Athens Festival, I'm Greek, and participating in this Vienna Art Festival, I realized that most of the questions addressed to me as an entrepreneur were, how quickly can you grow as a VC? So I found this a little bit annoying, because an investor should also be somehow like a strategic partner, because he has given you, has allocated you money actually in order to become a better version of yourself and your company, and in order to help you scale. So I think that somehow we have so much dictated today by growth and rapid scaling that we don't understand that something like this can actually make things perish and lose their value. So I see things actually completely go to waste. People's work actually go to waste, because some investors actually have asked for rapid scaling and rapid growth. And I am wondering, as I'm somebody who has been in the impact industry for many, many years, when do we learn actually to invest in the human, in the person, in the entrepreneur, and in the activity that the business is, engaging with? So I don't want a vulture fund, I want a humane fund, or a humane VC. So this is like a problem that we're dealing a lot nowadays as entrepreneurs.
This is exactly the point, right? About really, we say like the impact in it. It's like, if in the business model, the impact is like, inherent, and actually when you scale the business, you also scale the impact with it. Fantastic, right? That's very much so. So that's kind of, Erwin's approach, for example, really looking deeply at that. More and more, I would say, like, especially in this, I don't want to say room, but like whole building day, I think people are thinking of like really the impact in it. But generally, I guess the capitalistic system is still thinking more about growth. And I think that's the mindset shift we all are trying to achieve.
Trying to shift.
Right, trying to shift mindsets, but also seeing like maybe with different structures, how you can actually make it in inherently.
And make it sustainable and viable.
Is there another hand I saw? Yeah.
Well, I just wanted to add that, VC is not the only funding model in the market. It's a very specific funding model aimed at specific kind of enterprises. And that is for enterprises that can rapidly scale and deliver value. So that's the VC model. You take a high risk bet and subset you get, high reward. So I think, if your enterprise is not that kind of enterprise, it's fine. You should look for other funding models.
Absolutely. Sometimes it's harder to find those investors, but I think in your example, what you said, more and more investors come up. It's also this conversation of, let's call it a fair return, right? Like not a maximum return. Maybe you can share a little bit from your conversations with those investors, because you said you landed on like a 2.5 multiple as kind of goal in terms of return. Maybe how did you find those investors? How were the conversations going?
I mean, in our case, we found people who already knew and liked our product and wanted to support it, and said that this is what you hear a lot, that they say, I don't get the financial profit I could get somewhere else, but I get this other payback in terms of I feel like I'm supporting something great, or I'm funding an impact. And I think this is probably the challenge for all impact VCs, that if you can make the impact tangible and graspable for in your own funders, then you can also you can probably also offer them lower returns. But it's, at least for me, that's the challenge. How can I show this to funders that if I don't offer the great returns, what else can I offer you?
Good.
Yeah.
That's impact, basically. Good. Something to.
Yeah, but I think for me the biggest problem is the people running around saying, I can offer you maximum impact and maximum returns. A lot of people promise that, and I personally think it's a lie. But as long as someone offers both, then it's pretty hard to say. You have to compromise on something. You have to pick either one or the other.
Good, maybe we should talk more.
Just curious, anybody in the room already had an exit themselves and maybe wants to share some experiences or is thinking about it?
Non-financial one.
But good impact that was created.
Exactly. Yeah. What's happening back, karma, afterlife, that kind of stuff. But maybe for years I've been eyeing the sword ownership model, so I'm looking forward to chat with you afterwards in more detail. I think the framework doesn't exist in Austria from what I know. Last time I checked, we've been busy dealing with other entrepreneurial stuff, so I don't know if something changed. I think last time I checked it was a year and a half ago. And I think for me, I've been part of the space for 10 years or so, maybe more. And if you asked me 10 years ago, I would have thought kibbutz is a perfect model for organizing. I mean, I was born in communism, so I've seen that it's not perfect, doesn't work, right? But I thought how great the world, what a wonderful place the world would be if we would agree, look, everyone works with their ability, and it doesn't matter how much you get compensated because you're good, etc. Right? But now I'm a bit skeptical. I don't want to get crazy rich, right? I like fair returns, right? And I see that it's fair to compensate people for the effort they put. But I guess my half-baked question is, maybe you, Sebastian, but everyone else, how do you relate? How do you go about on philosophical level, right? How do you go about greed versus compensating yourself for all the effort that you put in, or maybe an idea that you have, and also how does that resonate with others that you work with, or maybe other people in the steward ownership community?
I think this is, for me, this is one positive aspect in steward ownership, because I think everyone gets greedy when there are opportunities. So if you talk to classic, to startup founders in an early stage, you ask them how much is enough, then most people, in Berlin probably, most people will say, well, 5 million, that's enough. But then at some stage, if you see 50, 500 million are possible, then 5 million, that's not enough. And what steward ownership means is that you define how much is enough at a stage where there's only very little, so you haven't already gotten greedy. And I think that for me is a good approach to also protect yourself from becoming too greedy.
I had an early stage femtech exit. It wasn't the exciting multi-million dollar, but it was exciting for us three founders. But in the sense, we were in a dilemma. Sorry for my voice, but we were in a dilemma because it was COVID. We needed funding. We were trying to build something that was going to change the lives of millions of women. We knocked on many different investors' doors, and they said the same line that you hear over and over again, so I don't need to go into it. So we were at a dilemma, a moral dilemma. What do? We knew we had a good product. We knew we had something that could scale. We were looking at the Indian market, so taking a problem like endometriosis, polycystic ovaries, just in the market alone, 50 million women, but we needed the support from the ecosystem, and it wasn't there. And so we sold to a company that took our IP, and I can say now safely they didn't do quite a lot with it. And that is a moral dilemma for a founder, because we didn't have another choice. It was either sell or close the company. So I think that's something that conversation it is being had, but it's a very difficult conversation. And I think the more we get more stakeholders at the table, so not just VCs, not just startup founders, but consumers, policymakers, everyone, and we start to really try to understand what are the problems we really need to solve on a systemic level, then I think the money may flow in different ways, different capital flows. And I think I'm a very staunch believer in the donor economics. I feel like everyone should reread that book over and over again, because there's so much value in it. And I think if we look at ourselves as an entire ecosystem, then the way we allocate capital will also flow in different ways.
I personally full-heartedly agree that certainly also what Tonic tries to work on, really changing the financial system, opening up the minds. It also was a little bit the goal for today. It doesn't have to be the classic VC equity model, but there are also other models out there that you can use as an entrepreneur, and also really preserving the impact. So yes, so much more mindset shift is needed, more sessions to do. I did see a hand there. Yeah.
Small question. When you're talking about, for example, full acquisition of a company, in many cases it's not a surprise for the company. In that case, what are your thoughts about, for example, if I have a startup in my portfolio, when should I start the preparation? Because it can take years to prepare a company for acquisition, to have, for example, connection with a strategic partner, etc., etc. So what are your thoughts about it? When it's not a surprise, it has to be a preparation.
Was there a question
for me?
Yeah.
I think we were totally unprepared. And I think this was exactly the case, meaning that when you build a company from the beginning and you build it in a good way, meaning that there is an impact and there is a very solid and sustainable business model, and the team is very much committed and so on, and you don't even think about an exit, and there is let's say an external event like regulation changes, ownership changes, really external event. If you're a business that is built in a good way from the start, meaning you didn't think about an exit when you started to build the business, we wanted the business to live forever. This is how we build the business. And this is why we didn't really need to be ready. It's not that it's an IPO that we needed everything, all the papers, and it was an opportunity to sell a good company in a stage where it was like generating incomes, also starting being profitable, and there was a buyer. So I think the timing is also something that is not always connected to the entrepreneur plans, and you need to think about how to build a healthy business, not only about the impact, but also a healthy business from the beginning, and buyers are always there.
Maybe, Erwin and Rune, from your perspective as investors, maybe you have some more insights to share, like in terms of, when do you start looking for, strategic buyers, like how long can that sometimes take?
I must maybe share like why I've seen it fail once in a while, and that's really not having your house in order. I think like, and it's maybe the same kind of mindset if you think you're so much in a hurry to like grow and like, just get a lot, but really forget everything around your admin and legal and that kind of stuff is not in order. Even if the opportunity arises, that's probably a reason why it's going to fail. Because a due diligence process in this kind of acquisition scenario will be quite in-depth. If you cannot deliver like the information that you ask for, I think you will fail quite early on in that process. And then I'm a big fan of being quite strategic around it. Really start engaging yourself with the partners that you think can be relevant for your future exit, and actually just building those relationships to have like early collaborations or interactions with them. We had businesses that actually ended up having no revenue, but because of the technology stack that they built and the relationships they managed to have with some large organizations. In this case, it was Oracle. They managed to build a really good relation with them. For Oracle, it was a very, very cheap buy, like a great team and some technology. And because they spent 3 years building that relationship, it was quite intentional for them to, okay, this could be an acquirer. So that starts quite early. It starts really, I think, at the moment that you actually have your product and your tech together, because there is always a challenge of scaling. Like really, can you really get into the market effectively enough as a small company? You don't really know what your acquisition cost is going to be, or how difficult it is to get customers. But if you build a really good product, really good tech, I think the biggest shames are where the solution is great, but they didn't manage to get the traction needed. And in those situations, I think you can actually manage to find a buyer if you build relationship really early on.
I totally agree on them. The question is whether you see it from the point of the investor. That means, for example, the fund. You do an exit. You can do it either by paying back a loan, put option. You can also make an IPO or sell your stake to another shareholder. But for the founder, I totally agree. You have to build relationships. You have to be prepared. You need a data room if you want to sell the whole company and not only a share. So that differs. Exit means for the founder selling the whole company, and we usually, as an investor, agree on that. If terms are okay. But there are some founders who do not want to sell their company. So this is the part where the exit for the investor is quite important, and giving over the shares to a next investor or shareholder. But being prepared is a very important and a step that you have to do.
Has anyone of you ever regretted an exit to a certain party, or even before that say, okay, it's a good financial deal, but I'm not going to sell to you as an organization or person? Have you ever come across that?
I mean, you have a problem, and if you try to sell a company to a strategic buyer, what we see is from time to time that, for example, a private equity company taking over the stake for a next stage is trying to, I would say, not have aligned interests between the founder and the actual shareholder or the investor, but to bring those parties not together, you know. And in that case, you have a different view on your return. That means, for example, if the founder and the investor do not get the same class of shares or cash, or the founder gets a signing fee that you would not accept as an investor, and in those cases, you have to rely on what you have arranged in the shareholder agreement when you invest in a company. So you have different positions when it comes to the valuation of a company, because the founder usually has an investment of his own work and his manpower, but not of cash. So the valuation when he steps in is quite zero. When he founded the company, for example, when we invest in a company and you have a valuation of 20 million euros for the company, and you find a buyer for the company that wants to pay 22 million euros. So for the founder, it's a big deal on the financial side, maybe also on the impact side. But let's just see the financial side. For us, it's not a good exit if you just get your money back, you know. So there can positions differ. And
non-financially, because you were not very aligned, or I think whether your ownership comes in, but that you had an investor where you think, okay, well, so I don't know, you have a windmill park and you think Shell wants to buy it, but not we're not going to develop it further. It is very black and white.
So you mean if you know at the time when you sell your share of the company that you have no further impact in the company or with the company? To be honest, usually if you sell your stake, you do not have any possibilities to control impact or to see. I mean, we even don't get information about impact after we have exited, because you're no longer a shareholder. You have no stake in the company. How can you get information and secure impact? It's the golden share model, what you can maybe use, but usually with those models, you won't find a strategic buyer.
Erwin, can I ask, what's the percentage of what's the success rate of the investments, if you can disclose that?
You mean in numbers or?
Just percentage-wise, how many of them you had to write off?
I think we have write-offs in the non-profit sector, 0. So all non-profits have paid back their loans, maybe 15, like that. And we did maybe 40 equity investments. And thereof, we have a failure rate of 30%, 40%.
That means 30% fail, or?
Fail.
Thanks.
So you have another 30 to 40% that is just paying the money back, and you have some home runs. We have a 3 to 10x. And all in all, you get a net positive return on the financial side. Regarding the impact side, we usually have more than double of that what we at the beginning tried to reach. So we are 200% of our target value, I think, for all of our funds. Not BonVenture 4, the latest funds, because we are still in the investment stage.
So I think that is also slightly different on the impact side, right? We have success rate or companies who make it a little bit more than in the traditional. You see, well, time is flying. I do want to acknowledge, definitely, please continue the conversation afterwards. I think what I'm taking away from our amazing panel today is that there are different ways how to preserve the impact past an exit, that they do look for a values-aligned buyer as much as possible, really preserving the impact by making the impact like baked into the business model, and then by scaling it, you also scale the impact. Put-call option, we heard, to already write into the shareholder agreement at the time of investment, or impact KPIs, also that you not only look at the financial KPIs, but also do look at the impact KPIs, or actually set up a company as an entrepreneur directly in a way that the exit is baked into it, and you actually stay, running the company in the long run. So different approaches from the traditional just maximum financial return. I want to leave you with that as some inspiration, some thoughts, but big round of applause for our panel.